Welcome to SecureBankBox, the ultimate solution for managing credit risk and UCC filings. Our powerful platform leverages SaaS and PaaS models to automate credit reporting and streamline processes. Ideal for banks, creditors, and businesses, SecureBankBox offers secure and scalable infrastructure at your fingertips. Experience seamless integration with cutting-edge technologies like blockchain and smart contracts. Our user-friendly SaaS interface makes data management and analysis a breeze, while PaaS allows for complete customization. Enjoy advanced features like audit trails and incentivization to ensure transparency and engagement. With SecureBankBox, bid farewell to manual errors and hello to compliance and innovation. Empower your institution today and be part of building a collaborative financial ecosystem. Welcome to the SecureBankBox 2025 Funding Expo, where the future of financial solutions unfolds before your eyes. Dive into our revolutionary liquidity management platform and advanced API integration systems that are setting the gold standard in banking technology. Experience live demonstrations and dynamic workshops led by industry leaders ready to transform your financial strategy. Network with trailblazing financial technology experts and gain invaluable insights into mortgage elimination strategies and investment management through our Gold-backed platform. Discover transformative secure banking solutions tailored for a new era of financial innovation. Don't miss the chance to access exclusive content and post-event resources designed to elevate your financial prowess. Take advantage of our early bird discounts and secure your spot in this unmissable opportunity for financial transformation and collaboration. Join us to reshape the future of banking and register today through our phone or email, setting the stage for unparalleled success with SecureBankBox.
All right, let's dive in. We're looking at this Supreme Court ruling, and it's got some people talking about, well, the future of money in America. Like, imagine state banks issuing their own currency, maybe even gold-backed. Could this be the start of something big, something that shakes up the Federal Reserve?
You know, what's really interesting here is how this ruling ties into the whole dual banking system thing we've got going on in the U.S.
Dual banking system.
Yeah.
Okay, gotta admit, that sounds kind of jargony. Break it down for us, like, why two separate banking systems in the first place?
Well, it goes way back, all the way to when the United States was just starting out. Big debates about how much power the federal government should have. A central bank. Should states have more say in managing their own money? All that led to two systems running side by side. You've got national banks, those are the ones chartered and regulated by the feds, and then you've got state banks overseen by, well, their individuals.
It's like a built-in check and balance. Both the feds and the states get a say in how banks do their thing.
Right. And this Supreme Court ruling, it's like it's opened up a whole new world for state banks. Now we're talking about them possibly issuing their own money, maybe backed by gold, totally bypassing the Federal Reserve.
Whoa, hold on. That sounds huge. But what would that even look like in real life? Could I just stroll into my local state bank and swap out my dollars for, like, gold coins?
A lot of folks are wondering the same thing, but hold your horses. It's not going to happen overnight. This ruling just lays the groundwork, gives states the legal go-ahead to explore these options.
So no gold rush just yet. Okay. But this does seem like a big win for that end the Fed crowd, right? The folks who want to, well, end the Fed.
It definitely fits in with some of their core ideas. This movement, they've been gaining steam lately. They want less power for the Federal Reserve. They say it's too centralized, not accountable enough.
And some of these folks, they're throwing around some pretty eye-popping numbers too, based on the national debt, the amount of gold the U.S. has tucked away. They're saying gold could be worth way more than it is now.
Those calculations, they definitely get your attention. And it's easy to see why people are excited about what it could mean for gold and silver. But got to be careful about making predictions based on just those numbers alone.
True. But even if those exact figures don't pan out, it still feels like this ruling could really shake things up, wouldn't you say?
Absolutely. And there are already groups out there like the Sound Money Defense League, Money Metals Exchange, pushing for sound money, encouraging states to go down this road. They see it as a chance for states to take control of their financial futures.
So what happens next? What should we be keeping an eye on as this all unfolds?
Well, the first thing to watch is which states decide to actually jump in. Some will be more eager than others, depends on their politics, their economic situation. You might even see some states teaming up forming like regional alliances to create a more unified approach to this gold-backed currency thing. Could get really interesting.
Okay, so let's say a state does decide to go for it. How do they actually set up a whole gold-backed system? I mean, where do they even get all that gold?
That's the big question, right? Well, there are a few ways they could go about it. They could start by just buying gold, on the open market.
Makes sense.
And there are also private companies, investors sitting on pretty big piles of gold. They might be willing to work with the states, partner up somehow.
And I'm guessing some states probably have some gold stashed away already, right? Like in their own vaults.
You're right. Some states, they've always held on to some gold going back to the days before the Fed even existed. So those existing reserves, that could be a starting point for a new gold-backed system.
So let's imagine a state manages to round up enough gold to back its own currency. How would that actually work for everyday folks? Would we be walking around with bags of gold coins?
Not necessarily. It doesn't have to be physical coins. I mean, it could be, but states could also issue paper money or even like digital tokens all backed by that gold they're holding.
Like digital gold.
Kind of. Think of it like those gold-backed stable coins, like what we've seen with cryptocurrency.
So instead of swiping my credit card, I might be using my phone with a digital wallet full of gold-backed tokens to buy groceries.
Could be.
That's kind of wild to think about. But what about people who aren't so into gold? Would they be forced to use this new currency?
Good question. It's really unlikely that any state would completely ban the US dollar.
Right.
More likely, we'd see both currencies running side by side. People could choose which one they want to use.
So kind of like how some countries use both euros and their own national currency.
Exactly. And in a way, that kind of already happens in the US, with some communities using local currencies, barter systems, things like that. It's all about having more options, more flexibility in how people do business.
But wouldn't having two different currencies floating around make things super confusing?
Well, there would definitely be some challenges to figure out for businesses and for regular people. But remember, we're living in a digital world now. Easy to imagine our phones, our devices, handling multiple currencies without a hitch, making transactions smooth and easy.
Okay, I can see that. So let's play this out. Say these state-backed gold currencies actually take off. What could happen to the US dollar? Could it lose its status as, the big dog, the world's reserve currency?
That's the million-dollar question, right? Has a lot of economists and policymakers scratching their heads. The dollar, it's been losing ground for a while now, national debt going up, inflation worries, all that geopolitical stuff. If these gold-backed currencies from states catch on, if people start using them a lot, it could definitely speed that process up.
So like a slow motion currency showdown.
Uh-huh. Yeah, kind of.
But what would it actually mean for, the average person if the dollar wasn't on top anymore?
Well, it could mean higher interest rates, making it more expensive to borrow money, for houses, cars, all that. Imported stuff could get pricier too, which means higher prices at the store. And of course, it could hit the value of your savings and investments.
Whoa, okay, a lot to unpack there. So should we all be running out to buy gold bars right now?
I wouldn't jump the gun just yet. It's all still unfolding. There's a lot we don't know about how this will all play out. Best thing to do is stay informed, do your own research, be ready for some potential changes in the financial world.
Right. Knowledge is power. But speaking of knowledge, I got to ask, what's your take on this whole gold-backed currency idea? I've heard some folks say it's just a nostalgic fantasy, a step backward.
It's definitely more complicated than that. Sure, gold has this long history as money, and some people do see it through rose-colored glasses, but there are real practical reasons why people are drawn to gold, especially when the economy feels shaky.
Like what? Why is gold seen as, a safe bet?
Well, unlike paper money, which governments can just print more of whenever they want, gold is finite. There's only so much of it. Its value isn't tied to what central banks or politicians decide. Plus, it's something you can hold in your hand, a tangible asset. Gives people a sense of security.
So it's like having a physical reminder that your wealth is real, that it can't just disappear because of inflation or, government decisions.
Mm-hmm. Exactly. And that peace of mind, it's really valuable, especially when you look at how crazy the stock market and other investments have been lately.
That makes sense. But wouldn't tying everything to gold, like a gold standard, really limit what the government can do to manage the economy? Like, wouldn't it be harder to deal with a recession or a pandemic if you're stuck with a fixed amount of gold?
That's a valid point. And it's one of the big arguments against a gold standard. Critics say it creates a rigid system, that it can actually hold back economic growth and make it hard to do effective monetary policy.
So it's a trade-off, right? You get stability, protection against inflation, but you lose some flexibility in managing the economy.
Yeah, that's a good way to sum it up. There are pros and cons to both sides. In the end, it's up to each society to decide what kind of monetary system works best for them, for their needs and values.
No easy answers there.
Yeah.
So let's talk about us regular folks. How could these state-backed gold currencies actually benefit people like you and me?
Well, one of the biggest potential benefits is that protection against inflation, like we talked about. If you're worried about the dollar losing its buying power, holding some of your savings in a gold-backed currency could help.
So it's like diversifying your portfolio, but instead of stocks and bonds, you're diversifying with different kinds of money.
Exactly. And for some people, it's not just about the money, it's about having more control over their finances, not being so dependent on a centralized system that they might not trust completely.
Like taking back some of that power and autonomy we talked about earlier.
Precisely. It's about having more choices, more freedom in how you manage your money.
Okay, so potentially good for both individual freedom and financial stability. But let's be real, nothing's perfect. What are some of the downsides, the risks with these state-backed gold currencies?
There are definitely some risks to think about. One concern is that if these state currencies aren't managed well, it could create instability, even financial crises.
So it's really important that states have a solid plan, that they know what they're doing when it comes to managing a gold-backed system.
Absolutely. Another risk is that these new currencies could be easier to counterfeit or to manipulate, especially if security measures aren't strong enough.
Right, we've seen how good counterfeiters are with paper money. And with digital currencies, there's always the risk of hacking and cyber attacks.
Exactly. Making sure these new currencies are secure, that's super important. And then there's the issue of convenience.
I was just thinking about that. Would every store, every business accept these new currencies? Could I use them to pay bills online?
All good questions. It would probably take a while for these new currencies to be widely accepted. Would take a lot of coordination between states, businesses, and regular people.
So it's not like overnight everyone's suddenly using gold-backed money. More like a gradual process, people slowly adapting.
Right. And that process, it could be messy, unpredictable. There might be some bumps along the way. But for the folks who really believe in gold-backed currencies, it's a journey they're willing to take.
Okay, so we've talked about the potential benefits and risks, the economics, the politics. But what does all this mean for me, just a regular person trying to make sense of all these changes?
That's the big question, right? And each person has to figure out their own answer. But I think the most important thing is to stay informed, know what's happening in the financial world, and be ready to adapt.
So like we're all in this together, trying to figure out what this new era of money might look like.
Exactly. And who knows, maybe someday we'll look back at this time and say, wow, that was a turning point when we started thinking about money in a whole new way, exploring new possibilities.
I like that. That's an exciting way to look at it. Well, listeners, my mind is officially blown. We've covered a lot in this deep dive. We've explored the potential for states to issue their own gold-backed currencies, what that could mean for the US dollar, the potential upsides and downsides for individuals. But there's one more piece of this puzzle I want to look at before we wrap things up.
Yeah, we've talked a lot about the economics, the numbers, all that. But what about the bigger picture, the philosophical side of things? This idea of states going up against the Federal Reserve, maybe issuing their own gold-backed money. It feels like a pretty big power shift, you know?
It definitely makes you think about some deep questions, like what is money, really? What's the role of government? What about sovereignty? For a long time, the power to create money, control it, that's been a big part of what makes a nation state a nation state.
Right, like having your own currency is a symbol of independence, being able to make your own decisions. Exactly. And now we're seeing this possibility of states within a nation saying, hey, we want some of that monetary authority too. It challenges the whole traditional way of thinking about money, the top-down model.
So it's not just about the dollars and cents, it's about who's in charge, who sets the rules.
Exactly. And for some people, this goes beyond just gold or silver. It's about pushing back against a federal government they see as too big, too controlling.
It's like a revival of federalism, states reclaiming some of that power they feel like they've lost over time.
That's a great way to put it. And it's fascinating to see this debate happening, not just among economists and lawyers, but in the world of ideas, political philosophy.
Makes you think about the very foundation of our country, the principles it was built on.
Absolutely. And it raises some big questions about the kind of future we want: a system where all the power is concentrated at the federal level, or a more decentralized one where states have more say.
That's a debate that's been going on forever, it seems like. And this whole gold-backed currency thing, it's like the newest chapter in that story.
Exactly. And we don't know the ending yet. It's a story that's still unfolding, but definitely one worth watching closely.
Well, listeners, we've reached the end of our deep dive into the world of state-issued gold-backed currencies. It's been a wild ride, lots of twists and turns, and we probably just scratched the surface of this whole thing. It's so complex and always changing.
But hopefully, we've given you some things to think about, some new perspectives, maybe even something to spark a debate at your next dinner party.
And remember, this isn't just some abstract theory, This could have a real impact on all of us in very concrete ways.
So stay informed, stay engaged, and as always, keep those minds curious.
Until next time, happy deep diving. Hey everyone, ready for another deep dive? We're getting a ton of questions about SecureBankBox, this platform that's supposed to change how we think about finance and logistics. Now I know what you're thinking. What do leveraged buyouts and financial modeling have to do with any of that? Well, our sources might not mention blockchain or SecureBankBox directly. But, and this is what I love about these deep dives, we're going to uncover some surprising connections that might just explain why a system like SecureBankBox is so groundbreaking.
It's true. Sometimes to understand where we're going, we have to look back at how things have always been done. See where the system as it is starts to show its cracks. And that's where something like SecureBankBox could really make a difference.
Okay, so let's start with the basics. Leveraged buyouts. LBOs. Anyone remember back in 2013 when Berkshire Hathaway and 3G Capital got together to buy Heinz? Classic LBO, right? Well, not so fast. Some people argued it didn't even count as a real LBO because, get this, the debt they used wasn't considered significant enough.
Ah, yes, the Heinz deal. It really highlights just how complex these deals can be. You see, at its core, an LBO is all about using borrowed money, a ton of it, to buy a company. The goal: boost its value like crazy, and then eventually sell it off for a huge profit. High stakes, high rewards.
Right, we're talking about massive sums of money here. But before you even think about buying a company, you got to figure out how much it's actually worth.
Right. Exactly. And that's where we get into this concept of enterprise value. It's not just about the stock price. It's about understanding the company's true worth, which means taking into account its debt, its cash on hand, the whole picture.
Okay, so you're saying we add back net debt to get the full value. But to me, more debt usually sounds like a bad thing, not something that increases a company's worth.
I know, it seems counterintuitive, right? But think about it like buying a house. You've got the price of the house, but then you've also got the mortgage. That mortgage is debt, but it's part of the total cost of owning the house. In the same way, when we're valuing a company for an LBO, we add back net debt. That's total debt minus cash, because we're looking at the price to own the entire business, which includes taking on its existing debt.
Ah, I see. So it's about looking at the full cost of ownership, not just a snapshot of its financials. And this is where I'm starting to see how SecureBankBox could come into play, right? I mean, if you have a system that increases transparency around a company's financials, maybe even their entire supply chain, wouldn't that make valuations so much more accurate and trustworthy?
Absolutely. And that increased trust is like gold for potential investors. Just imagine how smooth things could be if everyone involved had access to real-time verified data on the blockchain.
Okay, let's break down how an LBO actually works, step by step. What are the main stages?
Well, first things first, you've got to figure out the purchase price, which often includes what we call a control premium.
Control premium.
It's really.
Sounds ominous.
It's basically just a little extra you pay to convince the current owners to sell, like a sweetener.
Ah, so you got to sweeten the deal to get them on board. Makes sense.
Exactly. Then comes figuring out where all the money is coming from and where it's going.
Okay.
We call this the sources and uses of funds. And finally, you project what the investor's return is likely to be. For that, we use a metric called IRR, the internal rate of return.
Okay, so to make this more concrete, let's bring back the Heinz deal. Any juicy details stand out in that case?
Oh, absolutely. One thing that always gets me is the sheer amount they spent on transaction fees. Heinz had to shell out about $36 million to their financial advisor, Centerview, plus a cool $4 million just for signing on the dotted line.
Whoa, $4 million just to sign. That's a lot of ketchup packets.
Yeah.
Seriously, though, isn't it incredible to think that SecureBankBox could potentially simplify these transactions, cut out some of those middlemen, and maybe even slash those fees?
Oh, without a doubt. A blockchain platform like SecureBankBox could revolutionize how efficient and secure these transactions are.
Okay, let's talk about the elephant in the room when it comes to LBOs. Debt. It's like the fuel that drives these deals, but it also comes with some serious risks, right?
Right, you are. LBOs are all about high leverage, meaning a high ratio of debt to equity. And leverage is a bit of a double-edged sword. It can amplify your profits, but it can also amplify your losses. Think of it like a seesaw. The higher you climb on one side, the harder you fall if you lose your balance.
So you're basically playing a high stakes balancing act with a mountain of debt.
Pretty much. And it gets even more complicated because there are different types of debt involved in LBOs. You've got your bank loans, your high yield bonds, sometimes called junk bonds,
Mhm.
and then there's mezzanine financing, which is like a hybrid of debt and equity, each with its own risk profile and potential for returns.
Okay, so there's a whole spectrum of debt to navigate.
Yeah.
But how do you see something like Secure Bank Box changing the landscape of debt financing in LBOs?
That's a great question. Imagine a world where assets can be tokenized on the blockchain. Suddenly, you could use those tokens as collateral for loans, making the whole process much more transparent and secure. And with smart contracts, you could automate loan agreements and repayments, which would make the system so much more efficient.
So Secure Bank Box could bring a new level of automation and clarity to the debt side of these deals. But we can't forget about another vital element, cash flow. How important is that in the world of LBOs?
Cash flow is king in any business, but it's especially critical in LBOs. Lenders scrutinize a company's ability to generate enough cash to pay back all that debt they've taken on. They need to be confident that the company can service its debt obligations without, running into trouble.
Right, because you don't want to be stuck with a company that can't pay its bills.
Exactly. To understand cash flow, let's take a simple example, like a car company. Let's say they sell 100 cars a year, each for $20,000. That's $2 million in revenue. If each car costs $10,000 to make, then their gross profit is $1 million. But we're not done yet.
Okay, I'm following so far. We've got revenue and we've got the cost of making those cars. What else goes into figuring out cash flow?
To get to what we call cash flow from operations, we have to factor in things like salaries, rent, marketing, you name it, all those operating expenses. Let's say those add up to $500,000. That leaves us with $500,000 in operating income. That's the actual cash the company generates from its core business activities.
So it's not just about profit on paper, it's about the real money coming in.
Exactly. And here's another place where a platform like SecureBankBox could have a huge impact. By streamlining things like payments and inventory management, it could significantly improve a company's cash flow, making it healthier and more attractive for an LBO.
So Secure Bank Box could boost a company's cash flow. But how do analysts try to predict what a company might be worth down the road, and how does that affect an investor's return?
That takes us into the world of financial projections, which, let's be honest, involves a lot of data analysis mixed with a bit of educated guesswork. Analysts look at past performance, industry trends, and they even try to predict future market conditions to estimate things like revenue growth, costs, all those key metrics. It's a complex process, and, even the most seasoned analysts get it wrong sometimes. Remember Heinz. After the acquisition, their revenue growth actually went down. Not exactly what anyone was expecting.
So even with all that data crunching and expert analysis, predicting the future is still a bit of a gamble.
That's the nature of the beast, I suppose. But what if we had a system like SecureBankBox that could provide more reliable, transparent data? Imagine investors having that level of confidence, those insights. It could lead to much more accurate projections.
Okay, I see how Secure Bank Box could sharpen those predictions.
Yeah.
But let's zoom out for a second and go back to LBOs as a whole. We've talked about buying a company, boosting its value. But how does an investor actually make money from all of this? What's the end game?
Ugh, that's where the exit strategy comes in. The ultimate goal of any LBO is to sell the company later, hopefully at a much higher price, and generate a big profit for the investors. Think of it like flipping a house, but on a corporate scale.
So it's all about timing the market, finding the right buyer, and cashing in at the right moment.
You got it. And to figure out what that selling price might be, investors often use something called multiples of earnings. They might look at EBIT, earnings before interest and taxes, or EBITDA, which adds back depreciation and amortization.
So they're comparing the company to similar businesses to get a sense of what the market might be willing to pay.
Exactly. And ideally, they want to sell it at a higher multiple than what they bought it for. That's what we call multiple expansion. That's where the real money is made.
But what if the company doesn't perform as well as expected? or the market takes a turn for the worse. There's always that risk, right?
Of course, LBOs, like any investment, are inherently risky. There are no guarantees. That's why experienced investors do their due diligence, develop solid operational improvement plans, and they structure these deals very carefully to manage that risk as much as possible.
It sounds like a lot of work goes into mitigating those risks. But let's bring SecureBankBox back into the picture. How could this platform change the landscape of LBOs and the risks involved?
Well, if SecureBankBox delivers on its promise to transform financial and logistical processes, imagine a world where due diligence is streamlined, financial data is rock solid, and transaction costs plummet. The impact on LBOs could be huge.
It's a pretty exciting vision. More accurate valuations, easier financing, and potentially fewer of those hefty transaction fees we talked about earlier.
Precisely. And that increased transparency, it could go a long way in reducing some of those operational risks that are always lurking in the background.
Okay, let's zoom in on one of those key LBO elements we mentioned, the cash flow statement. Why is it so important?
Think of the cash flow statement as a company's financial heartbeat. It tells you how much actual cash is flowing in and out over a given period. It goes beyond just profitability on paper. It's about the actual movement of money.
Right, because a company can be profitable on paper, but still struggle to, keep the lights on.
Absolutely. The cash flow statement breaks it all down into three main categories: operating activities, investing activities, and financing activities.
Can you unpack those for us a bit?
Sure. Operating activities are all about the company's core business, making and selling stuff. It's about how much cash they're generating from their products or services. It includes things like sales revenue, payments to suppliers, employee wages, all that jazz.
So it's the heart of the business where the rubber meets the road.
Exactly. Then you've got investing activities, which involve buying and selling long-term assets, things like property, equipment, maybe investments in other companies.
So this is where the company is putting its money to work for the long haul. And what about financing activities?
Financing activities are all about raising and repaying capital. Think issuing stock, taking out loans, paying back those loans, paying dividends to shareholders, that sort of thing.
So it's about managing the company's financial structure, where the money comes from, and where it goes.
Exactly. Now, analyzing this cash flow statement is crucial in an LBO, especially for those lenders we talked about. It gives them a clear picture of whether the company can actually generate enough cash to pay back all that debt they're taking on.
It's make or break information.
Absolutely. And there's one specific element within the cash flow statement that's super important in LBOs: changes in operating working capital.
Working capital. Can you break that down for us?
Working capital is the difference between a company's current assets and its current liabilities. It's essentially the cash they have on hand to keep the business running smoothly day to day.
So it's the fuel in the tank for the company's operations.
You got it. And changes in operating working capital tell you how efficiently a company is managing its short-term assets and liabilities. For example, if a company can collect money from customers faster or stretch out payments to suppliers, that can really improve their cash flow.
It's all about fine-tuning those cash conversion cycles.
Right. Precisely. Investors in an LBO are always looking for ways to improve a company's working capital management to free up more cash, which can make the deal more profitable.
So more efficient working capital management can be a real advantage in an LBO.
Absolutely. To see how these changes show up on the cash flow statement, imagine a company's accounts receivable increase by, say, $100,000 during the year. This means they've sold more products, but they haven't collected the cash yet.
So that's a cash outflow. They've basically extended a loan to their customers.
Right. And on the cash flow statement, this increase in accounts receivable would be a negative number within the operating activity section.
Got it. So increases in current assets generally result in cash outflows, while decreases would lead to cash inflows. What about liabilities?
Same logic applies. If a company's accounts payable increase, meaning they're delaying payments to suppliers, that would be a cash inflow. They're essentially borrowing from their suppliers for a while.
They're getting a little breathing room.
Right. And on the cash flow statement, that increase in accounts payable would show up as a positive number.
So increases in current liabilities lead to cash inflows, and decreases result in cash outflows. Makes sense. Okay, we've covered cash flow, working capital. What about depreciation and amortization? Those always seem to pop up in financial discussions.
They are important concepts, especially when we're talking about LBOs. Depreciation is basically spreading out the cost of a tangible asset, something like a machine or a building, over its useful life. Amortization is the same idea, but for intangible assets, things like patents or trademarks.
So it's like acknowledging that these assets lose value over time.
Exactly. The key takeaway is that depreciation and amortization are what we call non-cash expenses, meaning they don't actually involve any cash going out the door.
Okay, so why include them in the financial statements if they're not actual cash transactions?
They're there to paint a more accurate picture of the company's financial health. They reflect the fact that these assets are, gradually wearing out or becoming obsolete over time.
I see. So how do they relate specifically to LBOs?
Well, they're added back to net income when calculating EBITDA. Remember, that's a key metric we discussed earlier for valuing companies and figuring out exit strategies.
Right, EBITDA. It's a way to assess a company's cash flow without those non-cash expenses muddying the waters.
Exactly. By adding them back, EBITDA gives investors a clearer picture of the company's underlying profitability and its ability to service its debt.
So it helps to isolate the company's cash-generating power, which is crucial in an LBO.
Absolutely. And speaking of getting a clear picture of a company's finances, let's shift gears to another fundamental statement, the balance sheet.
Okay, the balance sheet. Hit me with the key takeaway.
The balance sheet is like a snapshot of a company's financial position at a specific point in time. It shows what they own, what they owe, and what's left over for the owners.
So it's a quick health check of the company's finances.
You could say that. First, we've got assets, which are the resources a company owns or controls that have economic value. Things like cash, accounts receivable, inventory, property, even intangible things like patents.
So it's everything the company has that could potentially generate revenue or benefit the business in some way. What about liabilities?
Liabilities are the flip side. They're the company's obligations to others, basically what they owe. This includes things like accounts payable, short-term and long-term debt, deferred taxes, you name it.
So it's everything the company has borrowed or owes to suppliers, lenders, even the government.
Precisely. And then there's equity, which represents the owner's stake in the company. Equity includes things like common stock, preferred stock, and retained earnings.
So it's the portion of the company's assets that belongs to the shareholders.
Exactly. And here's a fundamental equation that governs the balance sheet. Assets equal liabilities plus equity. It's a balancing act. Everything has to add up.
It's all about keeping the books in balance.
Right. And in LBOs, analyzing the balance sheet is crucial because it gives investors insights into the company's financial structure, how much debt they're using, and their potential to generate returns.
So a healthy balance sheet is a good sign for a potential LBO.
Absolutely. And within the balance sheet, there's one item that I find particularly interesting in the context of LBOs, goodwill.
Goodwill. That sounds a bit fuzzy. What exactly does that mean in the world of finance?
Goodwill is an intangible asset that arises when one company acquires another. It essentially represents the amount paid for the acquired company that goes beyond the fair market value of its net assets.
So it's like paying a premium for things like the company's reputation, its brand, customer relationships, those intangible things that contribute to its value but are hard to put a precise number on.
Exactly. Think of it as the value of the company's good name or its potential for future earnings.
Okay, I'm starting to get it. But how do you actually determine the value of goodwill if it's so intangible?
It's calculated as the difference between the purchase price and the fair market value of the acquired company's net assets. So, for example, if a company is acquired for $100 million, but its net assets are only valued at $80 million, the goodwill would be $20 million.
Got it. It's the extra money paid on top of the tangible assets. But why would a company be willing to pay more than the fair market value?
They might believe those intangible assets, like the brand or the customer base, are actually worth more than their book value. Or maybe they're willing to pay a premium to gain a competitive edge or break into a new market. It's a bet on the future potential of that acquired company.
So it's a strategic move based on what they believe those intangibles are really worth.
Precisely. Now, goodwill is treated differently from other intangible assets. It's not amortized. Instead, it's subject to an annual impairment test.
So they're checking to see if the goodwill is still good, so to speak.
Exactly. If that test shows the value of goodwill has declined, the company has to record a charge on its income statement, which reduces its net income.
It's like taking a financial hit because that acquired company's intangible value has gone down.
Right. And in LBOs, goodwill can be a major factor in valuing a company and calculating the potential return for investors.
So investors need to really scrutinize the value of goodwill and the potential for those impairment charges when analyzing an LBO.
Absolutely. And speaking of carefully analyzing LBOs, let's move on to another critical piece, the debt schedule.
Okay, the debt schedule. Why is that so important in an LBO?
Remember, debt is the lifeblood of LBOs. A debt schedule lays out all the company's debt obligations, chapter and verse. It outlines the terms of each loan, the interest rate, when it matures, when the principal needs to be repaid, all the nitty-gritty details.
So it's like a roadmap of the company's debt.
Exactly. The debt schedule helps model the cash flows associated with the debt, things like interest payments, principal repayments, and any fees tied to the debt.
Makes sense. Investors need to know how that debt will be serviced and paid back over time to really understand if the deal is viable.
Precisely. And in LBOs, the debt schedule can get pretty complicated. Often you'll see multiple tranches of debt with different terms and priorities. It's not just one big loan, it's a carefully crafted structure.
Tranches of debt. Can you explain that a bit more?
Sure. Tranches are different layers of debt, each with its own level of risk and return. Senior debt, which is often provided by banks, is considered the safest for the lenders. It has the highest priority for repayment if the company goes belly up, and it typically carries a lower interest rate.
So it's like being first in line to get paid back if things go south.
Exactly. Then you have subordinated debt, which is riskier for lenders, but also offers a higher potential return because they're taking on more risk.
It's the classic risk-reward trade-off.
Right. And within these categories, you can have multiple tranches with different terms and maturity dates, which creates a fairly complex debt structure.
I see. So the debt schedule helps to untangle all those complexities and understand the cash flows associated with each piece of the debt puzzle.
That's it. And that's crucial information for investors when they're deciding whether an LBO makes financial sense.
Makes perfect sense. You mentioned mandatory and optional prepayments within the debt schedule. What are those all about?
Mandatory prepayments are principal payments that the company is obligated to make on the debt according to the loan agreement. It's like having a set payment schedule, kind of like a mortgage on a house.
So it's built-in discipline to make sure the debt is being chipped away as agreed.
Right. Optional prepayments, on the other hand, give the company some flexibility. They can choose to make additional principal payments if they have extra cash on hand. This can help reduce their overall interest expense, but it's not mandatory.
It's a way for them to strategically manage their debt and maybe even improve their overall financial health.
Exactly. And when investors are looking at an LBO, they need to take both mandatory and optional prepayment features into account. They have to see how those might affect the company's cash flow and ultimately the returns for the equity holders.
Sounds like there are a lot of moving parts to consider when it comes to the debt side of an LBO.
There definitely are. Another essential tool that investors use to try and predict how an LBO might play out is called sensitivity analysis.
Sensitivity analysis. Tell me more.
Sensitivity analysis is all about testing the robustness of a financial model. We want to see how much the results change if we tweak some of the key assumptions.
So you're basically playing what if with the numbers.
That's a great way to put it. In an LBO, there are so many factors that can influence the outcome. Things like the purchase price, the exit multiple, how fast revenue grows, even the interest rate on the debt.
So it's about identifying those pressure points, the factors that have the biggest sway over the deal's success.
You got it. Sensitivity analysis allows investors to change these assumptions one by one and see how it impacts the projected returns. For example, they might ask, what if the exit multiple is lower than we expect? Or what if revenue growth slows down?
So it's like running simulations, different scenarios to get a sense of how the deal could unfold under different circumstances.
Exactly. It helps investors to understand the range of possible outcomes and, get a feel for the level of uncertainty baked into an LBO.
It's a way to manage risk, essentially.
You could say that. A common way to present the findings of a sensitivity analysis is through what we call a sensitivity table.
A sensitivity table. Is that like a super complex spreadsheet?
It's a way to visualize how the projected returns change when we adjust those key assumptions. Imagine a table that shows the IRR or other important metrics under different combinations of those assumptions.
So you can quickly see how the numbers would shift if, say, the exit multiple were lower or the revenue growth rate was higher.
Precisely. It's a powerful way to understand the spectrum of potential outcomes and how much uncertainty we're dealing with.
Okay, I see how sensitivity analysis provides valuable insights for the investors. But what about the lenders? The ones providing the financing for the LBO. How do they protect their interests?
That's where we get into the realm of financial covenants.
Financial covenants. Tell me more.
Think of financial covenants as conditions or restrictions that lenders impose on a borrower as part of the loan agreement. They're like guardrails designed to protect the lender's investment and ensure the borrower maintains a certain level of financial health.
So it's like a set of rules that the company has to play by to keep the lenders happy.
That's a good way to put it. These covenants often involve specific financial metrics like debt to EBITDA ratios or interest coverage ratios. They're like tripwires that alert the lender if the company starts straying from the agreed upon path.
It's a safety net for the lenders,
Mhm.
essentially.
Right. And if a company trips over one of those tripwires, violates a covenant, there can be consequences. Things like higher interest rates, demands for faster repayment, or in extreme cases, even default on the loan.
So there's a strong incentive for the company to stay within the boundaries set by those covenants.
Absolutely. And in LBOs, where the debt levels are typically sky high, financial covenants become even more critical.
So the lenders are basically keeping a watchful eye to make sure their investment is protected.
Exactly. Now, let's look at some common examples of financial covenants used in LBOs. One of the most common is the debt to EBITDA ratio.
Okay, we've talked about EBITDA before. Remind me, what is that again?
EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's a way to measure a company's operating profitability.
Right, it strips away those non-cash expenses and focuses on the cash flow coming from the core operations.
You got it. The debt to EBITDA ratio essentially tells you how much debt a company is carrying relative to its operating profits. Lenders often set a maximum limit for this ratio to make sure the company isn't biting off more debt than it can chew.
So if the company's debt to EBITDA ratio goes above that limit, they could be in breach of their loan agreement.
That's right. Another common covenant is the interest coverage ratio. This one measures how well a company can generate enough cash to cover its interest expenses.
So it's basically making sure the company can comfortably pay its interest bills.
Exactly. Lenders usually require a minimum interest coverage ratio to ensure the company's operations are generating enough cash to stay afloat.
Makes sense. Another layer of protection for the lenders.
Right. And there's also the minimum liquidity requirement, which ensures the company has enough cash on hand to cover its short-term obligations.
So it's like a financial cushion to handle unexpected expenses or navigate short-term bumps in the road.
Precisely. When investors are analyzing an LBO, they really need to look closely at those financial covenants. They can significantly impact how the company operates and its overall financial flexibility.
It's all about understanding the risks and restrictions that come with the debt financing in an LBO. So we've seen how the lenders protect their interests, but what about the private equity firms that are driving these LBOs? How do they actually make money on their investment?
Well, there are a few ways they can cash in. One common method is what we call dividend recapitalization.
Dividend recapitalization. Sounds complicated. Break it down for me.
It's basically a way for the company to take on more debt to pay a dividend to its shareholders.
So they're adding more debt to the company to get cash back to the owners.
Exactly. Dividend recaps are often used in LBOs as a way for the private equity sponsors to realize some of their profits before they completely exit the deal. It's like taking an early payout.
I see. So they're taking some money off the table, so to speak. But doesn't adding more debt to the company make it even riskier?
It does. Dividend recaps can be controversial because they increase the company's leverage, which can put a strain on its finances if things don't go according to plan.
So it's a gamble, especially if the company's performance falters after that recapitalization.
Right. It's a careful balancing act.
Speaking of balancing acts, we've mostly been talking about the financial side of LBOs. But what about the legal and regulatory environment? Are there specific things to watch out for in that area?
Absolutely. LBOs operate within a complex web of laws and regulations, including securities laws, antitrust laws, and of course, tax laws.
So it's not just about crunching numbers. There's a lot of legal and regulatory due diligence involved as well.
You bet. Securities laws govern how securities are issued and traded. Since LBOs often involve new debt or equity being issued, investors have to make sure they're playing by the rules, including proper registration and disclosures.
They have to make sure all their I's are dotted and certs are crossed.
Exactly. Then there are antitrust laws, which are designed to prevent monopolies and promote competition. If an LBO involves buying a competitor, investors have to make sure the deal doesn't raise any red flags with antitrust regulators.
So they need to avoid creating a situation where one company has too much power and stifles competition.
Right. And then, of course, there are the tax implications. Tax laws can have a huge impact on how an LBO is structured and ultimately how profitable it is. Investors have to carefully consider things like the tax treatment of debt financing, depreciation, capital gains, all that fun stuff.
So they're trying to optimize the deal from a tax perspective as well.
Precisely. Navigating that legal and regulatory landscape can be tricky, but it's essential for investors to make sure everything is above board to avoid potential headaches down the road.
It's all part of managing risk and protecting their investment.
Exactly. Speaking of managing investments, let's talk about some of the key players who help orchestrate these complex LBO transactions. Investment banks.
Investment banks. They're the big dogs on Wall Street, right? What's their role in all of this?
Investment banks wear a lot of hats in LBOs. They act as advisors, financiers. They're involved on both the buying and selling sides of the deal.
So they're like the deal makers, the facilitators, bringing all the pieces together.
You could say that. On the buy side, they advise private equity firms on potential targets, help them do their due diligence, structure the financing, and hammer out the deal terms.
So they're like strategic and financial gurus for the private equity firm.
Exactly. On the sell side, they help companies identify potential buyers, figure out how much they're worth, manage the sale process, and negotiate the best possible terms.
So they're playing matchmaker, connecting buyers and sellers, and making sure everyone gets a fair shake.
That's a great way to put it. Investment banks are also key players when it comes to financing LBOs. They line up debt from banks and other big institutional investors, and they often underwrite and distribute the equity offerings needed to fund the deal.
So they're the financial architects, putting all the funding pieces in place.
I like that analogy. And they get paid handsomely for their services. Their fees are typically a percentage of the deal value, and those fees can be substantial.
So they're well compensated for their expertise and the risks they take.
Right. Investment banks are essential to the whole LBO ecosystem, and it's a highly specialized area that requires a lot of knowledge, experience, and the right connections.
It sounds like a fast-paced, high-pressure world.
It can be, but at the end of the day, LBOs are driven by the private equity firms who are putting up the capital and calling the shots.
Right. Private equity firms. Tell me a bit more about what they do.
Private equity firms are the investment companies that specialize in acquiring and managing companies that aren't publicly traded. They pool money from institutional investors, big players like pension funds and endowments, to fund their acquisitions.
So they're the ones with deep pockets, the financial firepower behind these deals.
Exactly. And they have a bunch of strategies to generate returns for their investors. One common approach is to buy companies that are undervalued or maybe struggling a bit. Then they work their magic. They improve operations, clean up the financials, and hopefully sell them later for a profit. It's like flipping houses, but on a much grander scale.
So they're like corporate turnaround experts, bringing their expertise and capital to help these companies get back on their feet and thrive.
You could definitely say that. Private equity firms also use LBOs to acquire companies that are already doing well, maybe to help them grow even faster or take advantage of opportunities when industries are consolidating.
So they're always on the lookout for strategic acquisitions that can generate big returns for their portfolio.
Precisely. Private equity firms usually have teams of experienced professionals who are experts at finding deals, conducting due diligence, building those complex financial models we talked about, and of course, improving operational efficiency. They're the ones who make it all happen.
So they have the brains and the brawn to navigate these intricate transactions and make sure the companies they acquire are well managed.
Right. Private equity plays a significant role in the economy. They provide capital and expertise to companies that might not otherwise have access to them. And they often contribute to job creation, drive innovation, and help fuel economic growth.
So it's not just about maximizing profits. They're also playing a part in supporting businesses and the economy as a whole.
Exactly. But it's crucial to remember that LBOs, like any investment, come with risks.
Of course, no investment is risk-free.
Yeah.
What are some of the key risks to keep in mind with LBOs?
One of the biggest is financial risk, which stems from, you guessed it, those high debt levels used to finance these deals. If the company's performance takes a hit, they could struggle to keep up with those debt payments, which could lead to default or even bankruptcy.
So that debt can be a double-edged sword. Amplify returns, but also magnify losses.
Exactly. And then there's operational risk, which comes with the challenges of integrating and managing the acquired company. Private equity firms often make big changes to how the company operates, and sometimes those changes can disrupt the business, leading to unforeseen costs or delays.
So it's the risk that those well-intentioned improvements don't go as smoothly as planned.
Right. And then, of course, there's market risk, which stems from things like a downturn in the economy or the specific industry the company operates in.
Things that are largely outside the control of the private equity firm.
Exactly. A weaker economy or a slump in the industry can really hurt the acquired company's performance, making it difficult to exit the investment profitably.
So timing and navigating those economic cycles can make a big difference.
It's crucial. And we can't forget about regulatory risk, which comes from changes in laws or regulations that could impact the company's operations or profitability.
So the rules of the game can change,
Mm-hmm.
and investors have to be prepared for that.
Right. And lastly, there's reputational risk. This can be a concern if the private equity firm is perceived as acting in a way that's detrimental to the company or its employees.
So they need to be mindful of the optics, how their actions are viewed by the public.
Absolutely. Managing all these risks effectively is key to making an LBO successful. Private equity firms typically do this through thorough due diligence, crafting operational improvement plans, and structuring the deals so the debt is manageable. And of course, working closely with management to navigate the post-acquisition integration. It's a team effort.
So it's all about being proactive, having a game plan, and being ready to adapt when things don't go as expected.
Exactly. Now, after all that work and risk-taking, let's talk about the potential rewards. How do we measure returns in LBOs?
That's the million-dollar question, right? What kind of returns are private equity firms hoping to achieve?
They're aiming for high returns to justify those risks we just talked about. Returns in LBOs are usually measured using the internal rate of return, or IRR. It represents the effective annual rate of return that the investment is expected to generate.
So it's a way to compare different investment opportunities, taking into account the time value of money.
Exactly. And while the IRR in LBOs can vary wildly depending on all sorts of factors, private equity firms typically target IRRs in the 20% to 30% range, or even higher.
That's significantly higher than what you'd expect from, say, investing in the stock market.
It is. Achieving those high returns requires a lot of skill and a bit of luck. It's about buying companies at the right price, improving their operations, boosting their financial performance, and then selling them at a favorable multiple.
So it's a multifaceted strategy that requires expertise, timing, and a little bit of good fortune.
You could say that, but it's important to remember that LBOs don't just impact the investors and the private equity firms. They also have a big impact on the acquired company itself.
Right. It's not just a financial transaction. It's a major event for the company, its employees, its customers.
Absolutely. LBOs can bring both benefits and challenges for the acquired company. It's not always a clear-cut outcome.
So it's a mixed bag. What are some of the potential upsides?
Well, one of the biggest benefits is that LBOs can give companies access to capital and expertise that they might not be able to get otherwise. Private equity firms often bring in experienced management teams, implement new strategies, and provide guidance to help those companies grow and become more profitable. It can be a real shot in the arm for a struggling company.
It's like a fresh start with a team of experts and a pile of cash to help them turn things around.
Yeah.
What about the existing shareholders? How does an LBO affect them?
Well, LBOs can provide liquidity to those shareholders, the ones who might be looking to cash out their investments. It gives them a chance to sell their shares and move on.
So it can be a win-win for both the private equity firm and the existing shareholders. Everyone gets what they want. But what about the potential downsides? What are some of the things that can go wrong in an LBO?
One of the biggest downsides is the increase in leverage. Remember all that debt we talked about? Taking on more debt can really strain the company's financial resources. And it can make it harder for them to invest in growth or weather those economic storms that inevitably come along.
So that mountain of debt can become a real burden if the company hits a rough patch.
Exactly. Another potential downside is the focus on short-term profitability. Private equity firms usually have a timeline in mind for their investment, and sometimes that can lead to cutting corners. You might see cuts in things like research and development or marketing, investments that are vital for long-term success, but don't necessarily show immediate results.
It's a trade-off between short-term gains and long-term sustainability.
Right. And what about the employees? How did they fare in an LBO?
Yeah, that's a big concern.
Well, sadly, LBOs can sometimes result in job losses. Private equity firms often look for ways to streamline operations, cut costs, and that can mean letting people go.
So it can have a real human cost.
It can. The impact of an LBO on the acquired company is complex and depends on a whole bunch of factors. The private equity firm's strategy, the industry the company's in, the overall economy, they all play a role.
So there are potential benefits, but there are also risks. And it's not always a clear-cut outcome.
Exactly. And I think this is where we can bring it all back to SecureBankBox. Remember, we talked about how SecureBankBox could potentially enhance transparency, efficiency, and trust in financial transactions. How could this platform specifically impact LBOs and the companies they acquire?
Right. We talked about how SecureBankBox could streamline due diligence, make valuations more accurate, reduce those hefty transaction fees. How could it actually change the game for LBOs?
Imagine a world where due diligence is lightning fast and rock solid, where financial data is readily available and verifiable on the blockchain, where transaction costs are a fraction of what they are today, and where supply chains are humming along like a well-oiled machine. That's the promise of Secure BankBox.
It sounds almost too good to be true.
It's definitely a game changer, that's for sure. Think about the potential impact. Secure BankBox could increase trust in those financial transactions, making LBOs potentially less risky for investors. And that could attract more capital to the private equity market, maybe even lower acquisition costs, and potentially make LBOs a viable option for a wider range of companies.
So it could democratize access to LBO financing, making it more inclusive?
It's definitely a possibility. And Secure BankBox's potential to streamline supply chains, improve logistical efficiency, that could make acquired companies more profitable, helping them manage that debt burden we talked about earlier.
So it could increase the chances of a successful LBO for both the investors and the company being acquired. Everyone wins.
Right. And by providing more reliable data, Secure BankBox could help investors make more accurate financial projections, which means they're less likely to overpay for acquisitions or underestimate the challenges of integrating the acquired company.
So it could make the whole process more efficient, more data-driven, and less prone to costly mistakes.
Exactly. It's still early days for Secure BankBox, but its potential impact on the world of LBOs is enormous.
It's definitely something to keep our eyes on. It could reshape the entire landscape of private equity and how companies are bought and sold.
It's amazing to think how blockchain, which started as the technology behind Bitcoin, could have such a profound impact on such a traditional area of finance like LBOs.
It's a testament to how innovation can really shake things up. How these seemingly unrelated ideas can converge and transform entire industries. Well, we've covered a lot of ground today. We've explored the fascinating world of leveraged buyouts, from the nitty-gritty of valuation and financing to the potential impact of platforms like Secure BankBox. It's been a wild ride, and I, for one, have learned a ton. I hope our listeners feel the same way.
We've seen how these complex deals work, the risks involved, the potential rewards, and the ripple effects on the companies being acquired. It's a dynamic area of finance, always evolving, always pushing the boundaries.
Exactly. And that's what we love about the deep dive, isn't it? Uncovering those unexpected connections, those hidden patterns that help us understand the bigger picture.
It's all about connecting the dots and seeing how those dots form a fascinating and often unpredictable picture.
Well said. A huge thank you to our expert for sharing their insights and guiding us through this intricate landscape. And to our amazing listeners, thank you for joining us on this journey of discovery. Until next time, keep exploring, keep asking those tough questions, and keep that curiosity burning bright.
Welcome to the Secure BankBox 2025 Funding Expo, where the future of financial solutions unfolds before your eyes. Dive into our revolutionary liquidity management platform and advanced API integration systems that are setting the gold standard in banking technology. Experience live demonstrations and dynamic workshops led by industry leaders ready to transform your financial strategy. Network with trailblazing financial technology experts and gain invaluable insights into mortgage elimination strategies and investment management through our Goldback platform. Discover transformative secure banking solutions tailored for a new era of financial innovation. Don't miss the chance to access exclusive content and post-event resources designed to elevate your financial prowess. Take advantage of our early bird discounts and secure your spot in this unmissable opportunity for financial transformation and collaboration. Join us to reshape the future of banking and register today through our phone or email, setting the stage for unparalleled success with Secure BankBox.